Hello everyone. Today is Sunday, the 12th of July 2026, and this is episode number 85 of JustDario Cigar Time. As I record this update, Iran says it launched missiles and drones at US-linked military sites in Bahrain, Kuwait, Jordan, Qatar, and Oman. This is in retaliation for renewed US strikes on Saturday. A few hours prior, at 7:15 p.m. Eastern Time on Saturday, U.S. Central Command began a third round of strikes this week against the Islamic Revolutionary Guard Corps in retaliation for the attack to the Cyprus flag container ship GFS Galaxy, transiting the Strait of Hormuz using the Omani lane under U.S. escort. The ship will likely sink as the whole crew abandoned it and has been rescued by local authorities, according to the UK FTO. Of course, there was a reaction in weekend oil prices to this series of headlines. However, the reaction remains fairly limited. As you can see on your screen, oil briefly jumped above $74 a barrel on Hyperlink to then quickly consolidate around $73.5 a barrel. The strong bearish bias in the oil market does not surprise anyone anymore. Finally, this week, we started to see the first high-profile commentators and analysts that till not long ago were all for the supply cut story to flame their narrative. They were quick to do a U-turn. Now, smelling that the wind is changing, they claim the oil futures market overreacted. They say it overestimated the positive news of the past month. Based on recent developments and inventory levels, they now foresee fair crude oil prices in the region of $80 to $90 a barrel. To be honest, I don't want to call these people clowns. That would be an insult to professional clowns, because being a clown is an honorable vocation. They make money performing in front of big audiences after mastering their skills for years. These flaky analysts and commentators do not deserve to be likened to them. Let's admit it. Not only the oil market is completely disconnected from reality, but now it behaves more like a prediction market than a real commodity market. It no longer follows the laws of supply and demand. The Strait of Hormuz is officially closed again by the IRGC until further notice. Military conflict now includes Oman, which was a neutral party and played an important role in pursuing a peaceful resolution till now. Massive drawdown in inventories across crude oil groups continue to be reported. The crisis in diesel is undeniable and growing, especially due to the Ukraine-Russia war escalation. The market has not priced anything of this. To be fair, it's hard to understand what these markets are pricing at all besides emotions, not differently from a prediction market. Prediction markets, let's not forget, that have already history of heavy manipulation of the odds and widespread insider trading. I assure you that next week, traders will fight hard to keep their positions in place. They will try to crystallize their gains into this month's OpEx expiration. This occurs on Thursday, July 16, for NYMEX crude oil options. Friday, it happens for stock and index options and futures. Option expiration is a key event in financial markets because it triggers large-scale position adjustment. These can significantly influence price action. OpEx occurs on the third Friday of each month. Quarterly expirations in March, June, September, and December are usually larger. On this day, equity, index, and ETF options contracts expire. They must be settled, exercised, or rolled over. This creates concentrated activity as traders roll or adjust position. The key driver is dealer hedging. Market makers are typically short options to provide liquidity. To stay delta neutral, they continuously buy or sell underlying stocks, futures, or ETFs. As price moves near expiration, gamma rises sharply, forcing larger and faster hedging trades. These can amplify moves or cause the market to ping to heavily traded strike prices. Additional consequences include surging options and stock volume with potential max pain influence. Max pain means that the price gravitates toward the strike where most options expire worthless. Volatility also heightens, especially in the final hours before the 4 p.m. Eastern cutoff on Friday. Because these flows are mechanical and predictable, they produce distinctive short-term behavior. Traders and algorithms actively monitor this. Ignoring it can expose portfolio to unexpected moves driven by hedging, not fundamentals. I'm sure the question on everyone's mind is what happens if a geopolitical event sparks a volatility spike during OpEx week. If a geopolitical shock combines with the mechanical forces of OpEx expiration, the reaction is typically more violent. OpEx week already features elevated gamma exposure, heavy dealer hedging, and position adjustments. When a shock drives realized and implied volatility higher, these structural elements amplify the move. Potential consequences include amplified hedging flows and slippery price action. Market makers who short gamma must delta hedge aggressively. They buy as prices rise and sell as they fall. In a negative gamma environment, this reinforces moves in both directions. Moderate reaction can turn into larger intraday swings or rapid reversals. A second consequence would be the breakdown of normal OpEx behavior. The usual pinning to popular strikes weakens or fades as high volatility overwhelms it. Markets experience choppiness with a higher risk of gaps or momentum overshoots. Third consequence is feedback loops and heightened tail risk. Hedging creates self-reinforcing momentum like gamma squeezes on the upside or accelerated selling on the downside. This raises the probability of forced liquidation and disorderly price action, especially in indexes with massive option activity like the S&P 500. Finally, elevated and persistent volatility can occur. The initial spike is extended, even after expiration clears. Volatility often remains elevated. It can expand into the following week as the volatility suppression from option positioning lifts. To summarize, the geopolitical shock does not occur in isolation. It collides with a market already primed for large moves due to gamma and flow dynamics. The result is typically bigger, faster, and more erratic price action. This creates elevated risk for both directional and volatility traders until the option slate resets post-OpEx. This interplay is why institutions, proprietary desks, and risk managers watch OpEx closely. Before we continue with the second part of today's podcast, I would like to announce I will host 2 live streams on Slice Finance on Monday, answering to significant demand from my subscribers and the amount of real-time information coming through. The live stream times are Monday at 10 a.m. Central European Time at 9 p.m. Eastern Time. This should give the chance to all my subscribers around the world to directly interact with me. Another thing I want to highlight, because I get asked this question a lot, is a strategy I posted on Slides this week. The strategy I suggest will help fellow gold bugs worried about the impact on gold prices from the escalating war in the Middle East. The strategy hedges exposures to gold at zero premium, capping gains till September while tightly hedging potential downsides. If you are interested in joining my live streams and accessing premium content on Slides, you will find the link in the description of this video. Now, let's continue with today's update. On Friday, President Trump posted that the ceasefire is over. However, he claimed peace negotiations will continue. This juggling of words was carefully crafted to keep the current narrative in place and not scare the markets. But it also delivered a message that can be used later to justify further reaction. So he won't be blamed for not warning the markets if anything occurs as a consequence to the end of the ceasefire. The most important update in the recent hours is that Iran targeted Oman for the first time. Specifically, they target the port of Duqm. This port is not close to the Iran shore, so successfully hitting it confirmed Iran's military capability has not been impaired over the past 4 months. The port is vital for supply and maintenance of the U.S. Navy, including carriers in the region. This type of damage and threat will surely be answered by the U.S. President and the U.S. military. Failure to do so will confirm dangerous weakness in the military apparatus supporting U.S. geopolitical strategy in the region. President Trump will answer this escalation strongly, especially since Iran ignored his Friday ultimatum. The ultimatum demanded Iran declare the Strait of Hormuz fully open and safe for commercial shipping by and Saturday. On the other side, we know how closely President Trump considers financial markets. His decision timeline is tight because U.S. stock and oil futures resume trading in about 12 hours. Effectively, President Trump is in a box now. He cannot continue to have his cake and eat it too. The current friction strategy and tit-for-tat escalation have only helped Iran resupply and strengthen its grip on the Strait of Hormuz. The only ships that crossed using the Omani lane in June needed heavy US military escort. That escort costs between $500,000 and $1 million per hour and is clearly unsustainable and dangerous. If you remember, I joked on X earlier this week. I asked how much fuel the US military is using to bring those ships back and forth. What those oil tankers carry might be consumed by the US military itself. Failure to answer this last escalation and Iran's claim they regained full control of the strait by force would be a huge geopolitical loss of influence. Furthermore, the conflict has now widened to the regions like the UAE, not target since April, and Oman, never target before. At the same time, we are entering OpEx week. As I described, triggering a volatility shock during OpEx week can be disastrous. A knee-jerk reaction could force traders heavily positioned short oil and long stocks to quickly unwind. That will cause a mess in both underlying and derivative markets. It could even trigger a rare Volmageddon events, like in 2020 for oil or 2018 and 1987 for stocks. That is why I believe the US administration will try to balance a show of force with limiting market impact. They will use narrative and oil price manipulation, which no one argues against anymore. It's worth noticing that call option position in crude oil future, despite bearish sentiment, increased significantly in the past 2 weeks. They were specifically purchased for the July 16 expiration. And for the first time since the war began, open interest in calls is much greater than puts for that expiration. This signals a group of traders believes oil prices will rise significantly next week. They either took speculative long or hedging positions against their shorts. Personally, I believe if events evolve as I described, oil should quickly close the gap you see now in the chart. The gap opened during the celebration of the MOU agreed between the US and Iran. An MOU that was just a show for both parties to regroup and reconsider strategies. Neither expected the military confrontation to be over. After that gap is closed, the situation becomes dangerous for many traders. According to my calculation and other well-educated analysis, CTA trading algorithms will start covering their positions shortly after. They will turn bullish on oil if we break the $85 to $90 per barrel level. Given the number of shorts positioned in the market that cause a stampede and trigger a broad short squeeze that might quickly propel oil above $100. And this is why I'm not surprised that among all the option strikes purchased in the past weeks, there were significant purchases at the $100 strike. This move will likely occur in a short period if things evolve as I said. But that alone won't trigger Volmageddon in oil, though volatility will rise. What could trigger a Volmageddon is a sharp and fast move reaching the $120 level hit in March. That was before the SPR release announcement, which had to manipulate the oil price all the way down to $70. But if we get to $120 again, at that point, the market has to face reality. Prices will be back at the level, but the SPR are depleted. Commercial inventories are super low, and there is no timeline for a full reopening of the Strait of Hormuz. If panic spreads, things can move fast, and honestly, I have no idea what could happen. No one expected on April 19, 2020 that oil could close at a negative territory at minus $30 a barrel the following day. Anyone forecasting that would have been deemed crazy. It is always impossible to know what can happen if a market breaks. Guidance considered the 1973 oil shock. That shock was not of this magnitude. Today's shock is much larger, but back then, oil prices quickly increased fourfold from the period before the embargo began. I'm not saying we will see $300, $400, or $500 next week. I don't care about a specific number. What I'm saying is we are entering an incredible dangerous window where anything can happen. There are so many unknown unknowns. The only thing you can do is sit tight and protect yourself. Be mindful and avoid trading this market because it can be incredibly dangerous. If you're not positioned by now, I'm not sure if the opportunity will still exist when futures reopen on Sunday. But since it is now clear that this tsunami is close to the shore, for those still waiting on the beach, I suggest you run for the hills and take cover. In my opinion, there is a chance things might turn nasty, and that should not be dismissed. Thanks a lot for listening to my podcast today. If you like my content, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss my future updates. I always appreciate your feedback, so feel free to drop them in the comments section. Thanks for supporting me on X and reading my research on JustDario.com. And thanks to those joining my premium platform on Slice. I wish everyone a nice Sunday and good luck. Bye.